Welcome back. In this Module 7, we're going to continue with Chapter 4, talking about the bookkeeping process. Now remember last time we talked about the fact that we use a journal as our book of original entry, and we make journal entries in which we debit accounts and credit accounts. Debits go on the left, credits go on the right. We include account titles, a date, and the amounts. Examples of journal entries are in your textbook. Page 105 in the yellow lines, you'll find some journal entries to look at. One of the things that you need to think about as you go through looking at journal entries is analyzing what's happening. Ask yourself, what's going on here in this economic event? We call that transaction analysis. There are 5 questions you can ask yourself. What's going on? What accounts are affected? How are they affected? Does the balance sheet still balance? And does what I've recorded actually make sense? So the first question, what's going on? Ask yourself, is cash going up? Is revenue going up? Is this an additional expense? What's actually happening as a result of this economic event? Once you know that, then you can say, okay, that's a cash increase, that's an account payable decrease, that's an owner's equity increase. You can analyze it as to what accounts are going to actually be affected by that economic event. Then ask yourself, am I sure that that's an increase in cash, or is that a decrease in cash? How are they affected? What direction should they be going, up or down? Then finally, after you've analyzed the transaction and you've written it down, does it still balance? Do the debits equal the credits? Do the pluses equal the minuses? Then the last question is the one that you need to ask yourself. Does it make sense? Is this really something I want to do? Does it make sense to have cash going down when I paid a bill? Yes, it does make sense. So ask yourself that question a lot. Is what I'm doing making sense? If it makes sense to you, it's reasonable. Now, as we're going through these next couple of topics here, realize we're going to be talking about journal entries, and ask yourself that last question as we go through. Is this actually making sense? Is this what should happen in this occasion? We're going to talk about 2 things that occur after we've made our original journal entries. They're called adjusting entries and closing entries. The adjusting entries are fairly easy to talk about. If you'll think back to the problem we worked in the last module, in which we bought supplies twice, and then at the end of the month we realized we didn't have all those supplies that we bought. We had to correct the amount of dollars that were showing under the supply account. We bought $90 worth of supplies and we bought $110 worth of supplies. So it was showing up that we had $200 worth of supplies, when in reality we only had $30 worth. So we had to subtract out $170 from our supplies, and that became then an expense. That is an adjusting entry. Adjusting entries occur when we have an account balance that's not what it should be. We're going to change the account balance to make it correct. That's an adjusting entry. There are 2 types of adjusting entries, accruals and reclassifications. In accruals, what we are doing is bringing on an expense that's not already recorded in our books. For example, if we had, as in that previous problem, been mowing yards and had not put that revenue on our books, we would have to record that revenue as a debit to accounts receivable and a credit to revenue. So we're bringing on expenses that aren't anywhere in our books, or revenues that aren't anywhere in our books. Those are called accrual adjusting entries. The second type of adjusting entries are called reclassifications. And that's what we did in the lawn mowing problem when we moved the dollars from supplies, the asset account, to supplies expense as part of our income statement expenses. That's a reclassification. We do a number of those types of transactions at the end of a month or at the end of the year when we're doing our adjusting entries. We look at things like prepaid rent, prepaid insurance, our inventory accounts. We make sure that those accounts have the correct amount in them, and if they don't, we reclassify the amounts in such a way that we get the balance to what it should be. 2 things to notice about adjusting entries. 1, there is never a debit or credit to cash. Cash is never included in an adjusting entry. 2, when you make an adjusting entry, almost always there will be a balance sheet account and an income statement account that will be affected. For example, you will take it out of your supplies, which is a balance sheet account asset, and you will put it into your supplies expense, which is an income statement expense account. So almost always your adjusting entry will have an income statement account and a balance sheet account, but it will never have a cash account. So never make an entry to cash when you're making an adjusting entry. Adjusting entries are performed at the end of an accounting cycle. Typically, they're done at the end of the month if you're going to do what we call closing your books at the end of the month to see where you stand. But more often they're done at the end of the year when you're closing your books for year end to see where your financial statements are going to be at the end of the year. These adjusting entries are made before the books are closed. And that's another term that we use a lot in accounting called closing the books. You may have heard that term used in different areas of the world in which you work. Sometimes the accountants will stay late at work to close the books. What you're doing when you're closing the books is emptying out all the revenue accounts and all the expense accounts so that you can start over again for the next month. Well, where are they going to go? If you empty out your revenue accounts and get them down to zero, and you empty out your expense accounts and get them down to zero, what's going to happen to them? Well, we move all of the revenues and all the expenses into retained earnings. Remember, retained earnings is affected by net income. Net income is the difference between revenues and expenses. So we're moving the income statement accounts, the revenue and expense accounts, into our retained earnings account. That way the net income effect is shown in our retained earnings reflects the net income effect. Typically you do this at the beginning of the year. You close out your revenues and expenses and you put them in retained earnings. You close your revenue accounts by debiting them. Remember they're credit balance accounts, so if you debit them, they'll have a zero balance. You credit retained earnings because you have to have an offsetting piece to that journal entry so your journal entry will balance. You close your expense accounts by crediting them. Now remember your expense accounts have debit balance, so to get them to zero you credit them and you debit retained earnings because you have to have an offsetting balance there. The net result is that net income ends up in retained earnings. So that's what closing entries are all about. So in this part of Chapter 4, we've talked about the journal entries, what they look like, what you think about when you're making a journal entry. And then we've talked about two specific aspects of the bookkeeping cycle when we're adjusting our accounts and making what we call adjusting entries. And we're closing our accounts where we're cleaning out our revenue and expense accounts, getting them to zero balances, and putting them into retained earnings. Note that when we do closing entries and clean out our revenue and expense accounts, we do not close out our balance sheet accounts. Balance sheet accounts stay on the books all the time. They're never closed out. The only accounts you close are revenue accounts and expense accounts. Well, let's do a couple of problems to see what this process looks like. Let's look at exercise 413 in your textbook. Exercise 413 is on page 125, about 2/3 of the way down the page. The questions this author asks are, assume that Carter Company has neglected to record a payroll expense adjustment at the end of October. In other words, they haven't adjusted their payroll expenses. The people have worked for part of the month, but that work is not being reflected in their journal entries, therefore it's not being reflected in their accounts, therefore it's not being reflected in their financial statements. What's the result of that? Well, if you don't have the expense on your books, then you have too few expenses, so your income is showing too high. So we call that overstated. Your net income for that month will be overstated because you're not recording an appropriate expense. In part B, they say, okay, what's the effect going to be for the next month? Well, in the next month, you're going to go ahead and pay them, so you're probably going to debit an expense and credit cash. That's going to show too much expense in the next month. So you're going to have too much payroll expense the following month. Therefore, your net income will be too low in the second month. In C, they say, okay, what is the net effect of these 2 months taken together? Well, they offset each other because you had overstatement in one month, understatement in the next month. They cancel each other out. But each month is wrong, but the overall effect is correct. So be aware that you will affect 2 different months if you forget to make adjusting entries. Finally, in the last question of this problem, they say, explain why the accrual adjustments should have been recorded, because we want to match revenues and expenses. Remember that matching concept we talked about in Chapter 2? We want to match the revenues with the expenses it took to earn them. We want to match our revenues and expenses. That's why we do adjusting entries. Let's do one more problem in this section to kind of see how this all fits together. And let's look over at problem 24. Problem 24 starts at about a third of the way down page 130. And if you'll notice, you have a number of transactions there listed A through G. Then at the bottom of the page, they give you an income statement. At the top of page 131, they give you a balance sheet. But these balance sheets and income statements are not complete. They have some dashes, some empty amounts in them. What you are to do is to take the information in the A through G transactions there and plug them in to those blanks on pages 130 and 131. Well, I couldn't replicate that on my slides, but what I'm going to do is show you the accounts and talk about how they are affected and give you the totals so that you can kind of check your work as you go along. Let's take them one at a time and see what's going on here. In Part A, rental commissions of $200 have been earned in August but have not been received or billed to the owners who owe you the money. Well, you've earned some money, but it's not on the books. That's an accrual adjusting entry. So you're going to have to increase your revenues. Well, you remember you increase revenues with a credit. So you're going to credit commission revenue. In turn, you're going to have to debit something for the $200 in an equal amount. That's money that's owed to you. So that's a receivable account. So the account that they use in your book is called commissions receivable. So you're going to debit commissions receivable $200, credit commission revenue $200. In Part B, when supplies are purchased, their cost is recorded as an asset. As supplies are used, a record is kept. The record sheet shows that $180 of supplies were used in August. Okay, this is a reclassification because you have supplies that have disappeared, $180 worth that have been used up. That's an expense. So you're going to increase your supplies expense by $180. The supplies asset account on the balance sheet is going to have to go down $180 because you've used up that asset. To decrease an asset, you're going to credit it $180. Number C, interest on the note payable is to be paid on May 31st and November 30th. The interest for this month, which is August, has not been recorded. That is, they haven't put it on the books. The $40 in interest payable that's showing up there is the amount from previous times. The interest on the note is 10%. Now you get to use that I equals PRT formula. To figure the interest, the I, you take your principal, and they tell you that the note payable amount is $2,400. They tell you the interest rate is 10%, so you take 240 times 10, and this is 1 month. So you're going to take it times 1/12, and that should give you, let me see what I got for that. I got $20. So our adjusting entry will be for $20. Now this is a note payable, so this is money that you owe, interest payable, and it's an expense to you. Interest is an expense of doing business. So you're going to increase your interest expense with a debit of $20. You're going to increase your interest payable with a credit of $20. Finally, in D, You have wages of $130 for the last week of August that have not been recorded. Wages, that's an accrual entry, accrual adjusting entry. You're going to have to increase your wage expense by $130, so you'll debit wage expense $130. You're going to have to increase your payables. You owe $130 to your workers, so you're going to have to credit wages payable $130. Next in D, the rent expense of the rent expense of $510 represents rent for August, September, and October, but you paid it in August. So what you did when you paid that, you debited your rent expense, you credited cash for $510, but not all of that $510 is rent expense. Only a third of it is rent expense. A third of $510 is $170. So you only want $170 in your rent expense account, so you need to take the rest of it out. So what you're going to have to do is decrease your rent expense. That would be a credit of $340. And you're going to have to debit your asset account of prepaid rent, $340. In letter F, interest of $140 has been earned on notes receivable but has not been received. This is money you've earned. This is revenue. So this is an accrual entry, accrual adjusting entry. You're going to increase your interest revenue by $140. To increase revenue, you're going to credit the revenue. It's owed to you, so that's going to be an interest receivable. That's an asset. Somebody owes you that money. So you're going to debit interest receivable $140. In letter G, the Board of Directors has met and declared a cash dividend of $1,400 payable in September the 10th. Once declared, the dividend is the liability. So you're going to increase a liability. To increase a liability, that's a credit. So you'll credit dividends payable. Then you will debit your dividend account under your retained earnings on your balance sheet. So what you see in the slide in front of you is a summary of the income statement adjustments, so that your net income becomes $4,000. And then on the next slide, you will see the adjustments that go on the asset part of the balance sheet. You can see your total assets are $14,550. And then finally, on the next slide, you can see your liabilities. Liabilities total $41,110, and then on the last slide, you see that your owner's equity and liabilities together total $14,550. So you know it balanced. Your total assets equal your total liabilities plus owner's equity. So you know your balance sheet and your income statement. Everything is in balance, so it must be correct. If you add up all your debits and credits that you made in those two middle columns, you will see that your debits and credits are the same numbers. They will total up to the same amounts. So I hope you have better understanding after reading Chapter 4 of the accounting cycle, beginning with the bookkeeping of analyzing a transaction, recording it in a journal, doing some adjusting entries, doing your closing entries, and finally coming up with some financial statements. In Chapter 5, what we're going to do is continue this process and look at the balance sheet in greater detail, still continuing to talk about journal entries, adjusting entries, and closing entries.